Something happened in the gold market that doesn't happen very often, and when it does, history shows that the people who pay attention are the ones who end up on the right side of one of the biggest wealth transfers in a generation. The banks just flipped, and I don't mean one bank. I don't mean a small regional player quietly shuffling some assets. I mean the institutional structure underneath this entire market just shifted in a direction that screams one thing louder than anything else. They know something. They know something, and they're moving before the rest of the world figures it out. So let's talk about what actually happened. Let's talk about what the commitments of traders' data is now showing us. Let's talk about why this signal is so rare, so significant, and so historically powerful that some of the most respected names in commodity analysis are using words like generational to describe what might be unfolding right now. And let's talk about what it means for you specifically if you're sitting on a retirement account, a 401k, an IRA, or any meaningful savings that you've spent your entire working life building up. Because here's the thing, this isn't a story about traders. This isn't a story about speculators chasing momentum. This is a story about the very institutions that run the financial system, the big commercial banks, the clearing houses, the entities with the deepest pockets and the most sophisticated research desks in the world, quietly, methodically positioning themselves on the right side of a trade that they have been on the wrong side of for years. And the reason that matters to you has nothing to do with trading futures contracts. It matters because these are the same institutions that manage trillions of dollars in pension funds, sovereign wealth accounts, and the retirement assets of everyday Americans. When they flip, they don't flip small. They flip with size, and that size moves markets. Let me explain what the COT report actually is, because this is the foundation of everything. The Commitments of Traders report is published every single week by the Commodity Futures Trading Commission. It's a detailed breakdown of who holds what positions in the futures market, how many long contracts, how many short contracts, and crucially, which category of participant holds them. You have managed money on one side, the hedge funds, the trend followers, the momentum chasers. And then you have the commercial participants, the big banks, the bullion dealers, the institutions that actually move physical metal around the world and use the futures markets to hedge their exposure. Here's what's critical to understand. Commercial participants, by their very nature, have been overwhelmingly short gold for decades. That's their structural position. They accumulate the physical metal in their vaults, and they hedge against falling prices by selling futures. So, when the price of gold rises, their futures book loses money. But their physical holdings gain. It's a hedge. It's insurance. It's been the permanent default position for the big commercial players since the modern gold futures market was created in the 1970s. Now, think about what happens when those same participants reduce their short hedges. Think about what it means when the institutions that have historically been the structural sellers of futures contracts start pulling back from that position. It means something has changed in their calculation. It means the risk they've always been hedging against, rising prices, is no longer the risk they're most focused on. It means they've either stopped believing prices will fall, or they've started believing the upside is so large that maintaining the short hedge actually puts them at a disadvantage. And right now, for the first time in a very, very long time, the commercial positioning in gold is showing us something extraordinary. The net short position, which for years has served as a ceiling on gold price rallies, has collapsed. The big commercial players have covered shorts at a scale that is forcing analysts at major research firms to pay attention. And when you combine that with the simultaneous increase in long interest from the managed money community and the backdrop of everything happening in the macro world right now, you start to understand why the word breakout keeps appearing in every serious research note being circulated on Wall Street desks this week. Goldman Sachs has a price target on gold that would have sounded like fantasy just a couple of years ago. J.P. Morgan's commodity research team, one of the most credentialed groups of analysts in the world, has published forward projections that put gold materially higher from where it stands today. Bank of America has been publishing notes for months about the structural tailwinds behind the precious metals complex. These aren't newsletter writers. These aren't YouTube channels. These are the most well-resourced financial institutions on the planet, and they are all pointing in the same direction with the same conviction. And here's the part that really matters. Here's what separates what's happening now from every other gold bull market you've heard about in your lifetime. The last time gold had a major institutional move of this magnitude, the setup was almost completely different. In the run-up to the 2008 financial crisis, gold was driven primarily by speculative flow. Hedge funds were piling in because they smelled blood in the credit markets. Central banks were actually net sellers during much of that period. The rally had legs, absolutely, but the foundation underneath it was fragile because it was built primarily on sentiment, not structural demand. Then came 2011. Gold hit what was then an all-time high, and then it spent 3 years slowly grinding lower as speculative positions unwound. And that's exactly what happens when a rally is built on speculative money rather than structural institutional demand. The speculators eventually get scared. They liquidate, and the price corrects hard. What you are watching right now is categorically different. Right now you have speculative money flowing in, yes. But underneath that, you have something far more durable. You have central banks that have been buying gold at the most aggressive pace in recorded history. You have commercial institutions covering short positions and reducing their structural hedges. You have sovereign wealth funds in Asia, the Middle East, and across the BRICS bloc actively diversifying away from dollar-denominated assets. And you have a physical supply picture that is quietly becoming one of the most bullish setups any commodity analyst has seen in decades. Let's talk about the central banks for a moment, because this is the story underneath the story. For most of the post-World War II era, central banks were sellers of gold. They viewed it as a relic. They viewed it as a dormant asset that produced no yield and occupied vault space that could be put to better use. The British government famously sold more than half of its gold reserves near the absolute bottom of the market. Gordon Brown, who was Chancellor of the Exchequer at the time, telegraphed the sales in advance, drove the price down further, and locked in losses for British taxpayers that are still painful to look at today. The low point of that sale, near the absolute trough of the gold market, is now literally referred to in the commodity world as Brown's bottom. That is how wrong conventional thinking about gold was just a couple of decades ago, and then something started to shift. In the years after the 2008 financial crisis, central banks quietly began accumulating again. It started with emerging market central banks, China, Russia, Kazakhstan, Turkey. Then it spread. Then it accelerated. And then after February of 2022, when the United States and its allies froze the Russian central bank's foreign exchange reserves, roughly $300 billion in assets that Russia had accumulated over decades, vaporized overnight by a keystroke. Something fundamental changed in how every central bank in the world thought about the risk of holding dollar-denominated reserves. Think about that for a second. A sovereign nation's central bank holding assets in the global reserve currency, following all the rules, keeping their reserves in the system, and a geopolitical decision made in Washington could make those assets completely inaccessible overnight. That was not a theoretical risk anymore. That was a demonstrated capability. And every central bank in every country that has any kind of tension, any kind of disagreement, any kind of strategic competition with the United States suddenly had to reckon with the fact that dollar reserves were not the risk-free asset they had always assumed. Gold is different. You cannot freeze gold. You cannot sanction it. You cannot block access to it with a financial system toggle. If it's in your vault, it's in your vault. It's yours. Full stop. And that simple fact, that gold is no one else's liability, has become one of the most powerful drivers of central bank demand the world has ever seen. Central banks around the world are now buying gold at a pace that would have seemed impossible to describe just a few years ago. And the key thing to understand about central bank buying is that it doesn't stop when the price goes up. Commercial speculators get scared by high prices and pull back. Central banks doing structural reserve diversification don't care about the day-to-day price. They care about having the allocation they need. They're buying the dips. They're buying the rallies. They're buying because they have made a strategic decision that they need more gold in their reserves. Full stop. And the hundreds of tons they are absorbing from the market every single quarter are tons that are simply no longer available to anyone else. Now, let's layer on top of that the supply picture, because this is where it gets really interesting. Gold mining is not a growth business. The major mining companies have been struggling for years to maintain production levels, let alone grow them. The easy deposits, the near-surface, high-grade, easy-to-access ore bodies that fueled the last great mining expansion, those have largely been mined out. The industry has been forced into deeper, more expensive, more technically challenging mines in more remote locations in more politically complex jurisdictions. The average time from discovery to first production for a new gold mine is now measured in decades, not years. So, even if every mining company on Earth started approving new projects today at a record pace, you would not see meaningfully more gold coming out of the ground for years. Meanwhile, demand is structural, it's growing, and it's being driven by the most powerful and determined buyers in the financial world. Central banks don't put gold back. When it goes into their vaults, it stays. So the supply that used to come from central banks recycling their reserves back into the market, that's gone. The scrap supply that surges during price spikes is not enough to meaningfully offset the demand. And the mining supply that makes up the bulk of the flow is essentially flat. When you have flat supply and rising structural demand, you have the physical conditions for a sustained price appreciation that isn't about a trade. It's about a fundamental repricing of an asset. And when you add the institutional signal from the COT report on top of that, The big commercial players reducing their shorts, the banks that know the physical market better than anyone covering their hedges. It starts to look less like a chart pattern and more like a paradigm shift. Now, I want to talk about the silver angle here for a moment, because silver is telling its own version of this story, and the numbers are almost more compelling. Silver, at its core, is a monetary metal with an industrial problem, or more accurately, an industrial opportunity that most people are dramatically underpricing. Silver is irreplaceable in solar panels. Every single photovoltaic cell requires silver paste for its conductors. And as the world pushes harder into renewable energy build-out, the demand for silver from the solar sector alone has been growing at a pace that commodity analysts are struggling to fully account for. Layer on top of that the electrification of transportation, the expansion of 5G infrastructure, the growth in medical applications, the use of silver in water purification. The industrial demand profile for silver is extraordinary, and it is growing. And yet silver has lagged gold significantly in this cycle. The gold-to-silver ratio, the number of ounces of silver required to buy 1 ounce of gold, has been historically elevated for an extended period of time. When that ratio compresses, it is typically silver that moves, and it typically moves harder and faster than gold. History shows that silver tends to be a late-cycle accelerator in precious metals bull markets. Gold leads, it establishes the trend, institutions get comfortable with the thesis, and then silver catches up with a velocity that surprises almost everyone who didn't position early. The same institutional move that's showing up in gold is beginning to show up in silver. And when the banks that just flipped to buy in gold turn their attention to silver with the same conviction, and there are real signs that process is beginning, the supply dynamics in silver are actually even tighter than gold, because a significant portion of silver supply comes as a byproduct of base metal mining. When the economy slows, lead and zinc and copper production slows, and silver production that comes with it slows. You get demand rising and supply constrained from two directions simultaneously. Hey, real quick, if you're watching this and you're thinking about how any of this connects to your own retirement accounts, I put together a completely free guide that walks through how thousands of American retirees are protecting their hard-earned savings right now using physical precious metals. It's in the description below. Worth taking a look if you have any concern at all about what's happening in the broader financial system. Let me talk about the macro backdrop, because the institutional flip doesn't happen in a vacuum. These banks are not moving into gold because of a chart pattern. They are moving into gold because the fundamental environment that surrounds gold is arguably the most supportive it has been in modern financial history. Start with the U.S. debt picture. The numbers here are almost too large to process meaningfully. The U.S. federal government is carrying a debt load that, by any historical standard, raises serious long-term questions about fiscal sustainability. Interest payments alone on that debt have grown to the point where they now rival defense spending as a category of the federal budget. And the trajectory is not improving. The structural gap between government revenues and government expenditures is persistent, and the political will to meaningfully close that gap through either higher taxes or significantly reduced spending has proven to be essentially non-existent across administrations and congressional compositions. The Federal Reserve, for its part, is trapped in one of the most difficult policy environments it has ever navigated. Raise rates too aggressively, and you blow up the debt service math, choke off growth, and risk a serious credit event. Keep rates too accommodative, and you allow inflation to run hotter than the mandate permits, eroding the purchasing power of every dollar-denominated asset in the system. There is no clean answer here. There is no policy path that resolves this tension without some form of financial repression. And financial repression, almost by definition, is bullish. For hard assets like gold and silver, the dollar itself is at an interesting crossroads. Its role as a global reserve currency has been the bedrock assumption underlying decades of American financial power. And while it's not going away tomorrow, the trend lines are unmistakably pointing toward a world with less dollar dominance, not more. BRICS nations have been openly discussing and quietly building the infrastructure for alternative payment systems. Trade deals are being struck in yuan, in rupees, in rubles. Currency swap lines between non-dollar economies are proliferating, and the dollar's share of global central bank reserves has been declining, slowly, unevenly, but persistently, for years. This is the context in which the big commercial banks are making their positioning decisions. They are not stupid. They have modeled these scenarios. They have stress-tested the macro environment. And the conclusion they are arriving at, the conclusion that is showing up in the commitments of traders' data as reduced short positions and increasing long exposure, is that the risk-reward calculation for gold has flipped. The traditional case for being structurally short gold, which was essentially a bet that the dollar system remains stable and inflation stays contained and central bank policies remain effective, that case has become harder and harder to defend. Let me tell you about 1971 for a moment, because there's a lesson there that is painfully relevant to everything happening now. When Richard Nixon closed the gold window in August of that year, when he unilaterally severed the link between the U.S. dollar and gold that had been the bedrock of the post-war Bretton Woods monetary system, most people didn't immediately grasp what had happened. Financial markets wobbled, there was some turbulence, and then things seemed to stabilize. Many mainstream economists at the time said it was fine, the dollar was strong, the system would adapt. But here's what actually happened over the following decade. Without the discipline of convertibility to gold, the Federal Reserve was free to expand the money supply at will, and they did. And the result was the worst sustained inflation the American economy had experienced since the Civil War. Consumer prices roughly doubled over the course of the 1970s. The purchasing power of the dollar was cut in half, and gold, which had been fixed at $35 per ounce under the Bretton Woods system, ran from $35 to over $800 per ounce by the end of the decade. Think about that. A move from 35 to over 800. That is not a trade. That is a monetary realignment. That is what happens when the system that was holding the price artificially down gets removed and the market is allowed to find the true price of hard money relative to paper money that can be created without limit. Now, are we at a 1971 moment? Is there some single event on the horizon that represents the breaking point of the current system? Maybe not. Maybe the transition is slower, more gradual, more distributed across years and policy decisions. But here's what the banks know that most retail investors don't. You don't have to predict the exact breaking point to to make money on the trend. You don't have to know exactly when the dam breaks. You just have to recognize that the cracks are there, that the pressure is building, and that the institutions with the deepest pockets and the longest time horizons are positioning themselves accordingly. And that's precisely what the COT data is now telling us. The commercial banks are not trying to catch the top tick on a short-term trade. They are making a structural repositioning that reflects their long-term assessment of where the value of gold relative to paper currency is headed. They have access to information about physical demand flows, about central bank reserve allocation decisions, about the movement of large lot physical bars through the global clearing system that simply isn't available to ordinary investors. And the signal they are sending with their positioning change is one of the loudest signals we have seen in years. This is actually the moment, and I want to be careful about how I say this because I'm not here to be alarmist, I'm here to be analytical. But this is actually the moment where the gap between what institutional players understand and what most retail investors understand is at its widest. The banks have already moved, the hedge funds are moving, the central banks have been moving for years. The last cohort to move historically is individual investors. The individual retirement account holders, the 401k participants, the people who are doing the responsible thing, saving diligently, and trusting that the conventional allocation advice they've received over the decades is going to hold. But here's what the conventional advice never adequately addresses. Conventional portfolio construction is designed for a world of functioning dollar hegemony, stable monetary policy, and predictable geopolitical relationships. It's not designed for a world where the reserve currency is being actively diversified away from by the very central banks that are supposed to hold it. It's not designed for a world where fiscal trajectories are structurally unsustainable, and the policy options for resolving that are all inflationary to some degree. It's not designed for a world where geopolitical risk has been reclassified, not by doomsayers, but by the risk management departments of the largest financial institutions on earth, from theoretical to operational. And here's something I want to say directly to anyone watching this who's in or approaching retirement. The most dangerous financial risk you face is not a bad year in the stock market. A bad year you can wait out. Markets historically recover. The most dangerous risk you face is a sustained, structural erosion of purchasing power that never fully reverses. The kind of erosion that happened in the 1970s, when people who thought they were comfortably set for retirement watched the real value of their savings shrink year after year after year as inflation ran well above any return they were getting from bonds and savings accounts. That is the scenario that physical gold in a properly structured retirement account is specifically designed to address.